Welcome to the deep dive. Today we're really peeling back the layers on how major investment decisions get made and what it truly takes for a new business idea to move from just a concept to a venture that's actually ready for capital. For this deep dive, we've really dug into the research on investment analysis and business viability. We uncovered this incredibly insightful 8-stage gated workflow. Think of it as a really rigorous filtering system. It's designed to test and refine business hypotheses. So our mission for you today is to unpack this so-shared approach. We want to break down its components and really understand how it objectively assesses if a business concept is truly ready for, well, significant investment.
Exactly. And this framework, it's crucial for evaluating feasibility, risks, potential returns. It helps ensure that only the most promising opportunities actually receive further investment.
Right, so it's about not wasting money.
Precisely. It's about minimizing wasted resources by moving from, a potentially great idea to a rigorously tested, data-backed proposal that's ready for the real world.
And to bring this powerful framework to life for you, we'll be following an imaginary case study, but it's highly detailed. It's a company called Vita Ltd. They're proposing mineral-enhanced, refillable water vending solutions across the UK.
It's a good one to illustrate the process.
Yeah. So if you're curious about what really goes on behind the scenes before big money flows into a new venture, you're definitely in the right place. Okay, let's unpack this. So first things first, let's really get our heads around this gated workflow. What exactly is it, and why is it so critical for these investment decisions?
Okay. Imagine a series of really tough checkpoints, almost like running a gauntlet. This 8-stage process is designed to measure the investment viability of, any business or project. It integrates strategic, financial, operational factors, everything.
Okay.
And only if an idea passes through one gate successfully does it sort of earn the right to advance to the next one.
So it saves time and money along the way.
Exactly. Saves valuable resources and time. Its core objectives are basically to objectively assess value and risks, spot those high potential opportunities, and provide a systematic, programmatic solution for investment decisions. It's about building confidence step by step.
Incrementally, yeah.
Ensuring only the most promising ventures actually get further resources.
That makes perfect sense. Sounds like a truly disciplined filtering mechanism, a really strict filter. And the very first step in this whole analytical journey, even before you hit gate 1, is defining the project hypothesis. What does that actually involve?
Right, the hypothesis. It essentially encapsulates the entire proposal, the business concept itself, the venture, maybe a change initiative. It includes the strategic intent, the value proposition, a high-level summary of the opportunity, some initial framing of the target market and what makes it innovative or gives it an edge.
So it's the core idea you're testing.
It's the core belief you're setting out to test, exactly.
Can you give us an example of how that works in practice, maybe a model from the sources you looked at?
Absolutely. The material we reviewed actually offers a fantastic template for crafting a clear hypothesis. It goes, if we introduce new product service solution to target market, then expected outcome will occur because supporting rationale.
Simple but effective.
Concise but powerful, yeah.
Okay, so applying that for our case study, Vita Ltd., what's their hypothesis as they step up to this whole process?
All right, Vita Ltd. proposes this. If we introduce a mineral-enhanced, refillable water vending solution that purifies public water and offers low-cost, eco-friendly refills to environmentally conscious consumers in the UK, then we will achieve rapid customer adoption and build a loyal, recurring user base. Because consumers are increasingly rejecting single-use plastics, seeking sustainable alternatives, and responding positively to cost-saving refill models, as evidenced by growing trends in reusable packaging, zero-waste retail, and the success of refill schemes in adjacent markets.
Wow. That level of specificity in the hypothesis is quite striking. It really lays out the what, the who, and that compelling why. It's almost like a mini business plan right there.
Exactly. It sets the stage perfectly for the first gate.
Right. So, with that crystal clear hypothesis in hand, the next major hurdle is gate 1, the business feasibility assessment. This is where, the rubber meets the road on whether the idea is even possible. Our sources break this down into 3 main parts: market, technical, and operational. Let's dive into market viability first. What metrics are used here to really understand the market opportunity? Is it just size?
Well, market viability aims for a standardized score. It looks at market size, yes, but also projected growth, the competitive landscape. Key metrics include the total addressable market, TAM, that's basically the entire potential market if everyone adopted it.
The theoretical maximum.
Right. And then the serviceable available market, SAM, which is a more realistic slice representing the segment they can actually serve effectively, geographically or through certain channels. We also look at historical and future market growth, and crucially, a really deep competitive analysis.
Okay, this is where it gets really interesting with Vita. Just how large is their market opportunity when you put it through this kind of lens?
Well, for Vita, the total addressable market, theoretically, everyone in the UK who could switch to their refillable mineral-enriched water is estimated at a, staggering 5.5 billion per year.
5.5 billion.
Yep. That assumes about half the UK population are eco-conscious consumers drinking 1.5 liters daily at, say, 130 per liter.
Okay, that's a massive theoretical ceiling.
Yeah.
But the serviceable available market, the SAM, that's usually where a company starts, right? A more realistic, immediate number.
Precisely. The SAM, which is the segment they can actually serve through targeted locations, think supermarkets, petrol stations, is estimated at 639 million per year.
Still very significant, 639 million.
Yeah, it's based on installing vending stations at about 26,000 high footfall sites. It's a significant, actionable target.
Okay. And what about competition? Is Vita jumping into a really crowded space, or do they actually have some breathing room here?
Well, what's fascinating here, and this is quite unusual, Vita currently has no direct competition in the UK for its specific mineral-enhanced refillable vending model. Zero.
No direct competition.
Really?
Yeah.
None directly doing the same thing. Indirect competition, sure, that comes from the broader UK bottled water market. That was valued at $6.47 billion in 2024, and is projected to grow. But the demand analysis specifically for Vita showed an estimated market demand of about 31.76 million liters per year, which lines up pretty well with their serviceable obtainable market, or SOM, estimates.
Wow.
So that lack of direct competition is a huge green flag.
That certainly seems to give them a strong competitive edge right out of the gate.
Yeah.
Okay, so how do they plan to price their product to capture this market then?
Their pricing strategy is quite strategic. Their price elasticity of demand, the PED, it's about minus 0.6.
Okay, remind us what that means. Relatively inelastic.
Exactly. It means their demand is relatively inelastic, especially in the early market. They can adjust prices moderately without a huge drop in customer interest.
Why is that?
Well, it's mostly due to that lack of direct substitutes for their specific offering, plus the strong environmental motivation among those early adopters. And get this, their cross-price elasticity of demand, the XED, which measures how changes in bottled water prices affect their demand, is positive 0.5.
So if bottled water gets more expensive...
Demand for Vita actually goes up. It's fascinating. They plan an introductory price of £0.30 per liter that positions them as, premium over tap water, but definitely value priced against bottled water. And that supports their whole sustainability narrative.
That's really clever, leveraging market dynamics and consumer values. So, after all that analysis, what's their overall score for market viability?
Vita achieved a composite market viability score, or CMVS, of 77.5 out of 100.
77.5, pretty high.
Yeah, what that tells us is they're tapping into a market with significant untapped potential, a clear pricing edge, and surprisingly, very little direct competition, even though it requires a behavioral shift from consumers. It's a strong signal for market entry.
Okay, so the market looks strong. Now let's pivot to the technical side. How is technical feasibility assessed within this framework? What are they looking for?
Okay, technical feasibility looks at three main areas. First, technology readiness level, or TRL basically, how mature is the tech. Second, resource and capability alignment. Does the organization actually have the skills and resources to implement it? And third, supply chain and delivery. It's about making sure the underlying tech and the team's ability to build and deliver it are sound.
Right, and for Vita, what's their technical feasibility score, their TFS? What does that reveal about the tech risk?
Vita scored 77.5 out of 100 on technical feasibility, same as market viability, interestingly.
Okay, 77.5 again. What does that mean in practice?
It indicates a low to moderate technical risk. Their core technologies, water purification, vending machines, they're mature, they're widely used. System integration can largely be done with off-the-shelf components.
So no reinventing the wheel.
Not really. Now, the founders might need external partners for, say, fabrication or complex electronics, but their core design and marketing capabilities seem strong. Their supply chain for components is robust too, though, there are always minor risks from potential supplier bottlenecks, but those seem manageable.
So the tech is solid, and they know how to get it built, which is a huge hurdle cleared for many startups. That just leaves operational feasibility. How do they measure whether this can actually run smoothly day to day and, crucially, scale up?
Right. Operational feasibility evaluates how well the venture can be executed efficiently, especially at scale. It assesses things like resource availability, cost efficiency, scalability, can they grow smoothly, and process optimization. It's really about the day-to-day nuts and bolts of making the business work reliably.
Tell us about WaterVita's operational picture then. Are they set up for success there? How did they score?
They scored well again, 78.25 out of 100 for operational feasibility.
Slightly higher even.
Yeah, just a bit. It means their operations look low risk and remarkably cost efficient, which offers strong early margins. For instance, their unit operating cost is estimated at just £1.10 to £1.15 per liter.
10 to 15 pence. Compared to bottled water.
Exactly. Compared to bottled water retail, maybe around £1.90 per liter. That yields healthy gross margins of 65–75%.
Wow, 65–75%. That's impressive.
It really is, especially early on. Plus, their machines are modular, which supports incremental deployment. They don't have to go big all at once. And core processes are automated. That's a significant advantage.
Those margins are striking, especially for an early-stage venture. What's the biggest operational challenge you see in maintaining those margins as they scale significantly? And, stepping back, what does this all mean when you combine market, technical, and operational feasibility? What's the overall picture at Gate 1?
Well, the big challenge will definitely be maintaining consistent machine uptime and efficient servicing across potentially thousands of locations. That's where the last-mile operational execution becomes absolutely key. You need reliability. Now, when we combine these three scores, market, technical, and operational, we get the Composite Investment Readiness Score, the CIRS. WaterVita's CIRS comes out at 77.73 out of 100.
Okay, 77.73.
Yeah, so that suggests they are pretty investment ready at this stage, with moderate to low execution risk overall. It's driven by that compelling market case, the solid technical base, and those efficient, scalable operations. It's a very strong start to the whole process.
Okay, so Gate 1 looks very positive. Now, with WaterVita's initial feasibility thoroughly examined, we kind of move from the what to the who, because an investment is rarely just about the numbers, is it? It's also about the visionaries driving the idea and, crucially, their alignment with those putting up the capital. This takes us to our next critical checkpoint, Gate 2, stakeholder alignment. What exactly does this gate evaluate?
Yeah, this gate is crucial. It assesses whether the venture really aligns with the goals, the values, and, importantly, the risk tolerances of key stakeholders, particularly investors. We measure this using a Stakeholder and Strategic Alignment Score, or SAS, and it looks at three critical areas. Strategic fit, does it match the investor's focus? Leadership and governance, is the team right? And mission and impact alignment, does it meet non-financial goals?
Right, finding that shared vision.
Exactly.
So how did WaterVita score here? Did they pick the boxes for investors looking for more than just profit, the ESG-focused ones?
They did very well here, too. WaterVita scored 80 out of 100 on the Stakeholder and Strategic Alignment Index.
80. That's a strong score indeed.
Yeah.
What specifically contributed to that, especially from an investor's perspective?
Well, their strategic fit scored an impressive 85. That indicates they squarely align with ESG funds, circular economy initiatives, urban sustainability programs.
The hot areas right now.
Absolutely. Their business model directly tackles growing environmental concerns, which makes it incredibly attractive to modern, values-driven investors. And their mission and impact alignment was even stronger, a 90.
Wow, 90.
Yeah, that's due to their direct contribution to reducing plastic waste, promoting sustainable hydration, cutting down transportation emissions. This also means they could potentially qualify for green innovation grants or local authority partnerships, which is a huge bonus for investors. Adds another layer of validation.
That makes perfect sense given their whole eco-friendly mission. But what about leadership and governance? That's always a big factor for investors, isn't it? You're investing in the team as much as the idea. How did they fare there?
This raises an important point. While their entrepreneurial leadership is credible, clearly engaged, the team scored 70 in this specific area.
70. Okay, lower than the others.
All right. It reflects a slight lack of deep sector expertise, specifically in vending hardware or maybe complex water purification systems at scale. It means they'll likely have a learning curve in areas like, say, regulatory compliance for water or maintaining these systems efficiently across a wide network.
Okay, so what does that mean practically?
Well, it suggests a greater reliance on maybe outsourced technical partners early on or the need to onboard expert advisors fairly quickly. And it also flags that their governance structures, board oversight, formal processes would need formalization as they grow. It's not a deal breaker, not a red flag, but maybe a yellow one that requires a clear plan to address it.
Got it. A point for investors to probe further. Okay, so far, Water Vita looks incredibly promising, clearing these initial hurdles with pretty high scores. But, what happens when things don't go perfectly? How resilient is their business model to unexpected bumps in the road? That's where scenario planning, financial evaluation, and risk assessment come in, right? Gates 3, 4, and 5.
Exactly. Gate 3, scenario planning, is all about testing that resilience under uncertainty. It involves stress testing the business model, pushing the numbers, conducting sensitivity analysis on key assumptions like what if sales are lower or costs are higher, and defining best, worst, and base case financial projections. It's about understanding the boundaries of their potential success and failure.
Okay, so how robust is Water Vita's model under that kind of stress? What do the different scenarios reveal?
Well, in their base case, the most likely scenario with 1,000 units deployed by year 3, they project a pretty healthy net profit of $5.48 million.
Okay, solid base case.
But the sensitivity analysis showed some vulnerabilities. For example, a 30% drop in sales volume in that base case would actually reduce them to near break-in.
Ouch. Sensitive to volume then.
Very. And a 20% increase in operating costs would slash profit by roughly $1.3 million. So this clearly highlights their sensitivity to both getting customers and controlling costs. The worst-case scenario, combining lower volume and higher costs, even projected a negative net profit of about menacing £662,000.
So they're definitely not immune to challenges. Those are clear areas for investors to watch closely. What about their overall financial health, separate from the scenarios? That's Gate 4, where we really dig into the core numbers, right?
Right. Gate 4, financial evaluation, assesses things like liquidity, can they pay their bills, profitability, capital efficiency, how well do they use investment, and cash flow. Water Vita achieved a financial evaluation score of 72.25 out of 100.
72.25. Okay, still good, but maybe not quite as stellar as the earlier gates. What does that tell us about their financial standing and appeal?
It indicates they are financially solid, definitely, with moderate investment appeal. Not bad at all. Their profitability and cash flow look strong, with an estimated EBITDA margin that's earnings before interest, taxes, depreciation, and amortization, a key profitability measure of about 33%.
33% EBITDA margin is pretty good.
It is, yeah. Capital efficiency is impressive, too, mainly because the asset requirements per vending unit are relatively modest, and their financial risk seems quite low due to a manageable 2 million bout load anticipated and strong recurring revenue expected per unit once established. So overall, they present a low-risk, steady-return financial profile, which is highly attractive to many types of investors, particularly those not just chasing explosive growth, but consistent returns.
That sounds like a financial picture many founders would, frankly, dream of.
Okay, finally for this section, Gate 5. Risk assessment. Every venture has risks. What are the biggest ones identified for Water Vita, and crucially, what are their plans to manage or mitigate them?
The highest identified risk for Water Vita, according to the analysis, is market risk. Specifically, the risk of lower than expected consumer uptake or just delays in people changing their habits. That scored 16 out of 25, which is categorized as high risk.
Interesting. So it's not the tech or the finances, but human behavior. Exactly. Their success really hinges on whether consumers will actually change their habits and embrace refilling regularly. It's a challenge many innovative companies face, right? It's not just building a better mousetrap, but convincing people to abandon their old ones.
Makes sense. So how do they plan to mitigate that?
Well, mitigation strategies include things like public education campaigns, carefully designed pilot testing programs in specific locations to learn and adapt, and probably strong incentives to encourage that initial adoption and build momentum. Other risks, like operational and financial risks, were rated as moderate. They require proactive management, things like ensuring unit reliability, managing liquidity carefully, and doing staged rollouts rather than a massive big bang. Regulatory risk around water standards was also seen as moderate, but the sources suggest it's viewed as less likely to become a major showstopper.
So market adoption speed is indeed the key variable to watch. It reminds me of other ventures that, faltered despite solid financials just because of those behavioral hurdles. What specific insights from the sources did you find most compelling on how Water Vita plans to actually accelerate that habit change?
Yeah, the sources emphasized a multi-pronged approach. Things like strong in-store promotion and really clear branding right at the vending sites. Strategic partnerships with supermarkets and petrol stations are key, obviously, to drive that footfall. And they mentioned a loyalty program to reward repeat refills, make it sticky. Plus, they're really banking on that existing growing trend of eco-consciousness providing a tailwind. It's about making the new behavior not just easy, but actually rewarding and aligning with people's values.
Got it. Making it easy and desirable. Okay, we've navigated Water Vita through all these crucial gates: initial feasibility, stakeholder alignment, resilience testing, financials, and risk assessment. So, now for the ultimate decision. How does this gated workflow bring all these diverse insights together? And what's the final verdict for Water Vita Ltd? What happens next?
Right, so once all the individual gate assessments are complete, the process moves to gate 6, which is called synthesizing insights. This is where all the quantitative scores and the qualitative observations, the notes, the context are consolidated and cross-referenced. You look for patterns, contradictions. Then, at Gate 7, decision criteria application, these synthesized insights are formally weighed against predefined investment criteria. These criteria might be things like minimum acceptable return on investment, the investor's specific risk tolerance, or how well it fits their strategic portfolio.
Applying the investor-specific lens.
Exactly. And finally, Gate 8 is the investment recommendation. This is where the full picture is translated into one of 4 clear decision outcomes on what they call a decision compass. The options are go, conditional go, defer, or reject.
The moment of truth. Okay, so what's Water Vita's final aggregate investment attractiveness score, the AIAS, after going through this entire rigorous gauntlet?
Water Vita Ltd. achieved a total AIAS of 76.07 out of 100.
76.07. And what does that translate to on the decision compass? Is it a green light?
Yes. That score falls squarely into the go band.
A go, nice.
Which indicates high investment readiness. It basically means they have strong mission and market alignment. They've demonstrated financial and operational viability. And the risks, while present, are seen as manageable with clear mitigation pathways already identified. It's a strong endorsement from the process.
So it's a go. That's a powerful positive outcome after all that scrutiny. Beyond just the score, what are the key highlights that truly push Water Vita into that go zone? And equally important, what are any remaining watch areas you'd advise investors or even the company itself to keep a really close eye on as they move forward?
Yeah, I think what truly stands out here, beyond just the score, is how a venture can achieve this investment-ready status without necessarily having some groundbreaking new tech. They did it by brilliantly applying existing mature solutions to address a really pressing societal problem, plastic waste, and cleverly tapping into those clear behavioral shifts towards sustainability.
That's a great point. Innovation isn't always invention.
Exactly. It's often about strategic execution and timing. The evaluation highlights those strong demand trends, the ESG-aligned model that investors love. A mature, proven technical stack reducing tech risk, and those modular, low-cost units generating potentially strong cash flow. Their financial metrics look solid, and they align exceptionally well with modern investors seeking both financial returns and positive impact.
Okay, and the watch areas?
The main watch areas remain, number 1, that dependence on behavioral shifts in the market actually happening at scale. Execution is key there. Number 2, the need for a really robust vendor integration and ensuring high uptime for their machines. They have to work reliably. And number 3, ensuring that scale and service reliability are thoroughly tested and proven during the rollout phase. Don't grow too fast. Oh, and that governance formalization we mentioned earlier, strengthening the board and internal processes, is definitely recommended to support growth.
Got it. So it sounds like a really competent early-stage investment opportunity with genuine, meaningful impact potential, a real potential win-win. Well, this deep dive really showed how a systematic approach like this gated workflow can properly peel back the layers of a business idea. It takes you from just a simple hypothesis all the way through to a comprehensive feasibility and risk assessment. And it's clearly not just about crunching numbers, is it? It's about connecting those numbers to market realities, operational capabilities, and even the leadership behind the whole vision.
Precisely. And in the case of Water Vita Ltd., the analysis revealed really strong foundations and that compelling ESG impact, positioning it as, a highly fundable venture. The careful weighing of market, technical, operational, and financial factors, combined with a clear-eyed understanding of the risks, transforms what might have been just a compelling concept into an actionable investment opportunity. It also clearly shows the value of identifying those specific areas, like governance or market adoption strategies, for refinement that can push a promising venture into even stronger territory.
And for you, our listener, this deep dive hopefully offers a crucial glimpse into the kind of comprehensive due diligence that underpins major investment decisions. It highlights that even the most innovative or impactful ideas require this kind of rigorous examination across multiple dimensions to truly assess their potential and de-risk them. It almost makes you wonder, doesn't it? If this model works so well for water, what other industries out there might benefit from a similar kind of refill and rethink approach? Food for thought.
So what stands out to you from WaterVita's journey through these investment gates? Are there other ways you think this kind of structured analysis could be applied, maybe in your own decision-making, whether it's a personal project or even a business venture you're considering? Join us next time on The Deep Dive.